All right, so it looks like someone's getting serious about investing.
You've given us quite the reading list.
Yeah, we've got Graham's classic, The Intelligent Investor.
Mm.
Some newer books on trading psychology, like The New Trading for a Living.
Right.
Even a deep dive into the Candlestick Trading Bible.
Wow.
Clearly, you're looking to up your investing game.
It's a fascinating mix.
Yeah.
This suggests you want a well-rounded approach.
Right.
You're not just looking for those hot stock tips.
Exactly.
You want to understand the market from different angles.
Yeah, and that's where we come in.
Yeah.
Today, we're on a mission to extract the timeless wisdom and the cutting-edge techniques that can help you build real, lasting wealth.
And we noticed you also included a few pages from El Inversor Inteligente,
Oh, yeah,
which seems to be the Spanish version of The Intelligent Investor.
that's right.
Interesting.
We'll have to have you back to translate that for us.
Uh-huh.
But let's start with Graham, the intelligent investor. It's considered the Bible of value investing for a reason.
Mm-hmm.
What are the core principles that still hold true today?
One of the most crucial ideas Graham presents is this concept of margin of safety.
Okay.
He argues that you should only buy assets when their price is significantly lower than what he calls their intrinsic value.
I see.
Think of it like this. You want to buy a dollar bill,
Okay.
but only if someone's willing to sell it to you for, say, 50 cents.
So it's about finding those hidden bargains in the market. Buying things for less than they're actually worth.
Exactly. And this principle is as relevant today as it was decades ago.
Okay.
It's about being a disciplined buyer,
Right.
not getting swept up in the hypermarket frenzy.
That makes sense. But markets move so fast these days.
Yeah.
Doesn't that make it harder to find those bargains, those opportunities with a large margin of safety?
It's definitely more challenging in a fast-paced market,
Right.
but the principle remains the same.
Okay.
The key is to focus on understanding the true value of a business, not just its current stock price.
Okay, so how do we go about determining that intrinsic value in today's market?
That's where the real work comes in.
I bet.
It involves analyzing financial statements, understanding industry trends, and evaluating a company's competitive advantage.
So it's not just about picking a stock based on a gut feeling or a hot tip.
Definitely not.
Okay.
Graham emphasizes a rational, analytical approach.
Mm-hmm.
It's about being a business analyst as much as an investor.
Interesting.
And that brings us to another key takeaway from Graham.
All right.
The difference between a defensive and an aggressive investor.
I'm guessing defensive doesn't mean hiding all your money under the mattress?
Not quite.
Okay.
It's more about understanding your own temperament and risk tolerance.
I see.
A defensive investor prioritizes safety and stability,
Mm-hmm.
while an aggressive investor is willing to take on more risk for potentially higher returns.
So step one is figuring out what kind of investor you are.
Exactly. And that leads us to another brilliant concept from Graham. Mr. Market.
Mr. Market.
Imagine the market as this moody character who shows up at your door every day,
Okay.
offering to buy or sell you stocks at different prices.
Okay. That's a pretty interesting image.
Yeah.
So how does this Mr. Market help us?
Well, the key is to realize that you don't have to take Mr. Market's offer every day.
Right.
Sometimes his prices are ridiculously high.
Yeah.
Other times they're way too low.
Mm-hmm.
Your job is to recognize those extremes
I see.
and act accordingly.
So it's about having the discipline to walk away from a bad deal,
Exactly.
even if everyone else seems to be buying it.
You get to decide when to buy or sell, not Mr. Market.
Mm.
That's the essence of being an independent investor.
Okay.
Now, all this sounds great in theory,
Right.
but there's another crucial aspect to investing that Graham doesn't delve into as deeply:
And what's that?
the psychology of trading.
Ah, that's where the new trading for a living comes in, right?
That's right.
It seems like a completely different approach to investing. Less about spreadsheets and more about, our own minds.
That's right. It's about recognizing that even if we understand the numbers,
Yeah.
our own emotions can sabotage our success.
Oh, for sure.
This book emphasizes that the first step is acknowledging that we can't control the market,
Right.
but we can control ourselves.
So it's about accepting that we're going to make mistakes, that we can't predict the future perfectly.
Precisely, successful trading isn't about being right all the time.
Okay.
It's about managing risk and staying disciplined,
Right.
even when your emotions are screaming at you to do something impulsive.
That sounds challenging.
It is.
How do we even begin to master our emotions when there's so much money on the line?
The book advocates for a few key strategies.
Cool.
One is to approach trading with a business mindset, just
Okay.
like Graham suggests.
Mm-hmm.
Develop a plan. Stick to it.
Right.
Treat your trading capital as a precious resource that needs to be protected.
So it's about being professional and not letting emotions like fear or greed cloud our judgment.
Yeah, exactly. Another key concept is risk management.
Okay.
The book recommends risking no more than 2% of your total capital on any single trade.
2%.
Think of it like this. If you're a recovering alcoholic, you wouldn't hang out at a bar, right?
Okay, that's a powerful analogy.
Yeah.
So we need to set clear boundaries to protect ourselves from potential losses.
Exactly. By limiting your risk on each trade, you're converting good intentions
Right.
into the reality of safer trading.
I see.
It takes the emotion out of the equation and helps you make more rational decisions.
That makes sense.
Now, this may sound very different from Graham's approach,
Yeah.
but notice the common thread: discipline.
That's
So
interesting.
whether we're analyzing balance sheets or managing our emotions,
Mm-hmm.
discipline is key to long-term success.
Absolutely. And that brings us to a book that seems to offer a more systematic approach to investing.
Okay.
The Little Book That Beats the Market.
Oh, yes.
It claims to have found a simple formula that can consistently outperform the market.
A bold claim.
This magic formula, does it really work as well as the book suggests?
The book's backtesting shows impressive results.
Oh, okay.
But like any strategy, it's not foolproof.
Right.
It's based on two key metrics:
All right.
high return on capital and high earnings yield.
Okay, so break those down for me.
Sure.
What do those terms actually mean?
Return on capital tells you how efficiently a company uses its money to generate profits.
Okay,
It's like a measure of their business savvy.
got it.
Earnings yield is about getting a good bang for your buck when you buy a stock.
Mm-hmm.
It's the earnings per share relative to the stock price.
So we're looking for companies that are both profitable and undervalued by the market.
Exactly. It's a value-oriented approach,
Okay.
like Graham's philosophy.
Right.
It's not about getting rich quick,
Okay.
but about buying good companies at bargain prices
Mm-hmm.
and holding them for the long haul.
So are you saying we should just blindly follow this formula and ignore everything else we've learned?
Not at all. Any approach, it has its limitations. The market is constantly changing, and what worked in the past may not work in the future.
Right.
Consider it a tool in your investing toolkit,
Okay.
not a guaranteed path to riches.
Okay, so far we've covered value investing,
Right.
managing our psychology,
Mm-hmm.
and even this intriguing magic formula.
Yeah.
Now let's get a little more visual.
Okay.
The Candlestick Trading Bible
Right.
talks about these patterns that can supposedly reveal insights into market psychology.
Interesting.
Can you decode some of this for us?
Well, candlestick patterns are a form of technical analysis
Mm-hmm.
that originated in Japan centuries ago.
Wow,
They offer a visual representation of price action,
I see.
allowing traders to get a sense of the market's mood swings.
Okay.
We've been talking a lot about emotions in investing.
Yeah.
Well, these candlesticks supposedly let you see those emotions playing out on the charts.
This seems like a very different approach from Graham's focus on fundamental analysis.
It is.
Can these patterns really help us make money?
That's a debate that traders have been having for centuries.
Really?
Some swear by candlestick patterns, while others see them as little more than reading tea leaves.
Uh-huh.
They can be helpful for timing entries and exits,
Mm-hmm.
but the underlying fundamentals of the company and the overall market trends still matter.
So it's not a magic bullet, but potentially another tool in our arsenal.
Exactly. Let's focus on a couple of patterns mentioned in your source material.
Okay.
We have kangaroo tails, which represent those failed attempts to push the market in one direction.
Right.
They often signal a potential reversal, a change in momentum.
So those long wicks on the candlesticks are like a tell.
That's one way to think about it.
Okay.
They reveal the strength of buyers and sellers at certain price levels.
I see.
And then we have engulfing patterns, where one candlestick completely engulfs the previous one.
Mm-hmm.
These suggest a potential shift in power from bulls to bears, or vice versa.
All right. I'm starting to see how these visual clues could be useful, but
Yeah.
it still feels a bit like learning a secret language.
It does take some practice to interpret these patterns correctly.
Right.
And remember, they're just one piece of the puzzle.
Okay, so we've got long-term value investing,
Mm-hmm.
psychology-driven trading,
Yeah.
a magic formula for stock picking,
Right.
and now these visual candlestick clues.
It's a lot to take in.
It feels like a lot.
That's the beauty of it.
Yeah.
You've given us diverse sources because successful investing requires a multifaceted view.
I see.
There's no single right way to approach the market.
So where do we even begin?
Yeah.
How do we put all this information together into a coherent strategy?
That's a great question.
Yeah.
And it's one we'll delve into further in the next part of our deep dive.
All right. Sounds good.
But first, let's take a closer look at some specific examples from these sources
Okay.
to see how these concepts play out in the real world.
That sounds like a plan. Let's see how these ideas translate from theory to practice.
Let's do it. Welcome back to our deep dive into the world of investing. You've given us a lot to think about.
Yeah, it's a lot.
And that's a good thing.
I know.
We've explored the foundations, the psychology, even the visual language of the markets.
Right.
Now let's talk about how to turn all this knowledge into action.
Okay. Yeah, I'm ready to roll up my sleeves and get practical. We've covered a lot of ground. But how do we actually APPLY these ideas to build a winning investment strategy?
One of the most valuable things you can do is develop a system for evaluating investment opportunities.
Mm-hmm.
This should be based on your own goals, risk tolerance, and the amount of time you're willing to commit.
So it's not about blindly following someone else's playbook.
Right.
It's about creating a framework that works for me.
Exactly. And remember, Graham emphasizes that investing is most successful when it's approached like running a business.
Okay.
That means analyzing financial statements.
Like what kind?
Those balance sheets, income statements, cash flow statements.
So we're talking about really digging into the numbers.
Yeah.
Understanding a company's financials inside and out.
That's right. You want to see how profitable a company is,
Mm-hmm.
how healthy its finances are, and whether it has potential for growth.
Okay.
Graham provides a number of ratios and metrics to help you assess these factors.
This reminds me of the magic formula from the little book that beats the market, focusing on return on capital and earnings yield.
Yes.
Would you say those metrics are also essential for someone following a more Graham-style approach?
Absolutely. Return on capital tells you how effectively a company is using its money to generate profits.
Right.
It's a measure of their business acumen.
Got it.
And earnings yield gives you an idea of the return you can expect based on the company's earnings relative to its stock price.
So like we talked about earlier, it's about finding companies that are both profitable and undervalued by the market.
Precisely. And the little book argues that by consistently investing in companies that rank highly on these metrics,
Yeah.
you can outperform the market over time.
It sounds deceptively simple.
It does.
But like you said before, it's not about finding a magic bullet. There's always an element of risk and uncertainty.
Of course, it's about tilting the odds in your favor
Right.
by investing in companies with strong fundamentals.
Okay.
Now, while understanding those fundamentals is essential,
Mm-hmm.
we also need to address the emotional side of investing.
Right.
This is where the new trading for a living comes in.
That's right. The market can be a roller coaster,
It can.
and our own emotions can lead us to make impulsive decisions.
Mm-hmm.
How do we manage that fear and greed, especially when the market is volatile?
One crucial step is developing a trading plan
Okay.
and having the discipline to stick to it, even when your emotions are telling you to do something else.
So it's like having a set of rules that govern your trading decisions.
That's a great way to put it.
Mm-hmm.
Your trading plan should outline your entry and exit points, your risk management strategy,
Right.
and your profit targets.
I see.
By following your plan, you're taking the emotion out of the equation
Right.
and making more rational decisions.
This reminds me of what the book said about treating trading like a business.
Yes.
You wouldn't make business decisions based purely on emotion, would you?
Exactly. Now, one key aspect of your trading plan should be a solid risk management strategy.
Okay.
This involves things like position sizing,
Position sizing.
which refers to how much capital you allocate to each trade.
So we're talking about how much money we're putting on the line for each individual investment?
That's right. And the new trading for a living recommends risking no more than 2% of your total capital on any one trade.
2%. Wow, that's pretty conservative.
That may sound conservative,
Yeah.
but it's designed to protect you from devastating losses.
So even if you're wrong about a particular trade, you're not going to wipe out your entire portfolio.
Exactly. By controlling your position size, you're controlling your risk,
I see.
which in turn helps you manage your emotions and stay in the game for the long haul.
Okay, I'm starting to see how all of these pieces fit together, you know?
Mm-hmm.
You need a solid foundation in value investing, a well-defined trading plan, and a disciplined approach to risk management.
It's about building a robust framework for success.
Yeah.
Precisely. And now let's add another layer to this framework.
Okay.
the visual insights we can glean from the candlestick trading Bible.
Right, we were talking about those candlestick patterns that supposedly reveal market psychology.
Yeah.
How can we use them to inform our trading decisions?
Candlestick patterns can be particularly helpful in identifying potential turning points in the market.
Okay.
For example, the bullish engulfing pattern suggests that a downtrend might be about to reverse into an uptrend.
So it's a signal that the bulls are starting to gain control.
That's the general idea. This pattern consists of two candlesticks.
Okay.
The first is bearish, indicating sellers are in control.
Right.
But the second is bullish, and it completely engulfs the body of the previous candlestick, suggesting that buyers have overwhelmed the sellers.
So it's a pretty dramatic shift in momentum.
Exactly. And on the flip side, we have the bearish engulfing pattern,
Okay.
which signals a potential reversal from an uptrend to a downtrend.
So it's a sign that the bears are taking over.
Right. Again, it's a two-candlestick pattern. But this time, the second candlestick is bearish and engulfs the previous bullish one.
Right.
It suggests that sellers have taken control from the buyers.
Okay, so these patterns can help us identify potential trend reversals. But isn't there a lot of noise in technical analysis?
There is.
How do we know which signals to trust?
That's a great point. And it's why you should never rely solely on candlestick patterns or any single form of technical analysis. They should always be used in conjunction with other forms of analysis,
Okay.
like fundamental analysis and your own assessment of the overall market environment.
So it's about combining technical analysis with fundamental analysis, risk management, and a clear trading plan.
Exactly.
It sounds like we're building a multi-layered approach to investing.
Precisely by integrating all of these elements, you can create a truly robust investment strategy
Right.
that's aligned with your individual needs and goals.
That makes sense. Now let's talk about something that's drastically changed the investing landscape.
What's that?
Technology.
Ah, yes, technology. It's a game changer.
It really is. We have access to so many tools and resources these days
I know, it's amazing.
that weren't available to investors even a decade ago.
Exactly. Online brokerages, financial news websites, investment research platforms.
Right.
These tools have empowered investors to take control of their finances and make more informed decisions.
But with so much information at our fingertips, it can also be overwhelming.
It can.
How do we filter out the noise and focus on what's truly important?
One helpful approach is to develop a clear investment philosophy
Okay.
and then use technology to support that philosophy.
So if you're a value investor, you might use online tools to screen for undervalued companies.
Exactly.
And if you're a technical trader, you might use charting software to identify potential trading opportunities.
Precisely. Technology should be used as a tool to enhance your decision-making, not to replace it.
Okay.
It's important to remember that you're still the one in control.
So we can't let the technology become a crutch
Right.
or make decisions for us.
No,
We need to be the ones in the driver's seat.
absolutely. And remember, there's no substitute for sound judgment and careful analysis.
Right.
Don't blindly trust any algorithm or software program. Always do your own due diligence.
That's a great reminder. We need to be discerning consumers of information.
Yeah.
Especially in the digital age.
Exactly. Now, we've covered a lot of ground in this part of our deep dive.
Yeah, we have.
We've explored specific strategies, discussed the role of technology, and emphasized the importance of developing a personalized approach to investing.
Right.
But before we move on to the final part,
Yeah.
I want to acknowledge that this is a lot to process.
It definitely is. And I think it's important for our listener to remember that investing is a journey, not a destination.
That's a great point.
You know, there's no need to try to master everything overnight.
Don't feel overwhelmed.
Yeah.
Start with a solid foundation and then gradually build upon that foundation over time.
Right.
Stay curious. Be open to learning from your mistakes.
Mm-hmm.
And remember that success in investing is about progress, not perfection.
So we should approach investing with a sense of curiosity, a willingness to experiment, and a healthy dose of patience.
Absolutely. Now, are you ready to delve into the final part of our deep dive?
Let's do it. I'm excited to see how we bring all of these ideas together. All right, we've covered a ton of ground in this deep dive into investing, from Graham's classic wisdom to the psychology of trading. Even those fascinating candlestick patterns, it feels like we've opened up a whole toolbox of ideas and strategies.
And that's exactly the point. We've explored diverse approaches because successful investing requires a multifaceted view. There's no one-size-fits-all answer.
Right. That makes sense, but it can also feel a bit overwhelming. Where do we even begin to apply all this knowledge?
One of the most consistent themes we've seen across all these sources is the importance of independent thinking, whether it's Graham urging us to be skeptical of Mr. Market or The new trading for a living, stressing self-awareness. It's clear that blindly following the crowd is a recipe for disaster.
So we can't just copy someone else's strategy no matter how successful they seem.
Exactly what works for one person might be completely wrong for another. Your investment approach should align with your own risk tolerance, your time horizon, and even your personality.
Okay, that makes sense. But how do we actually develop that independent thinking? It feels a bit daunting to go against the grain, especially when you're starting out.
It all begins with education. That's why you've given us this stack of sources to analyze. Keep reading, keep learning, and most importantly, start applying what you learn. Don't be afraid to experiment and find what works for you.
Yeah, that's where the rubber meets the road, as they say. It's one thing to read about investing, but it's another thing to actually put those ideas into practice.
It's exactly. To test out different strategies, track your results, and be honest with yourself about what's working and what's not. This process of trial and error is how you develop your own unique edge in the market.
So it's about becoming a student of the market, A&D, a student of yourself. We need to understand the external forces driving prices, but also our own internal biases and tendencies.
Precisely, the more you understand both sides of the equation, the better equipped you'll be to make sound investment decisions. It's about finding that sweet spot where your knowledge and your temperament align with the opportunities in the market.
This reminds me of what the new Trading for a Living said about treating trading like a business. It's about being professional, disciplined, and constantly seeking improvement.
Absolutely. And just like any successful business, your investment journey requires a solid plan. This is where the concept of diversification comes in. We've touched on this a bit, but I think it's worth emphasizing.
Yeah, you're right. Diversification is one of those fundamental principles that applies to just about every investor, wouldn't you say?
Absolutely. Think of it like this. Would you put all your eggs in one basket? Especially if that basket could potentially fall and shatter.
Definitely not. That's a recipe for disaster.
Exactly. Diversification means spreading your investments across different asset classes, sectors, and even geographic regions. This helps to reduce your overall risk and protect your portfolio from the inevitable ups and downs of the market.
So it's like a safety net for our investments. We're not putting all our faith in any single company or sector, no matter how promising it seems.
That's a good way to think about it. Even the best companies can experience setbacks, and entire industries can face challenges. Diversification helps to ensure that even if some of your investments don't perform well, others can help to cushion the blow.
So we're spreading the risk and increasing the likelihood that at least some of our investments will do well over time.
Precisely. Diversification is a core principle that applies to both long-term investors and short-term traders. It's a way to protect your capital and increase your chances of success.
Okay, so we've got education, self-awareness, a solid plan, and diversification. Anything else we should keep in mind as we embark on this investing journey?
One more crucial ingredient, patience. All the sources you've provided emphasize the importance of thinking. Long-term building wealth is a process, not an event. It takes time, discipline, and the ability to ride out those inevitable market storms.
So there's no magic formula for getting rich quick.
I'm afraid not. Sustainable wealth creation is about making informed decisions, managing risk effectively, and letting the power of compounding work its magic over time.
So it's about playing the long game, not getting distracted by short-term noise or those tempting get-rich-quick schemes.
Exactly. Focus on building a solid foundation, stay the course, and you'll be amazed at what you can achieve with patient, disciplined investing.
This deep dive has been incredibly insightful. It's given me a much clearer understanding of how to approach investing in a way that aligns with my own values and goals. I feel like I have a roadmap for success.
That's fantastic to hear. And remember, the most important investment you can make is in your own knowledge and self-awareness. Keep learning, keep growing, and never stop investing in yourself.
This has been an incredible journey through the world of investing, and I feel like we've only just scratched the surface. But that's also exciting because it means there's so much more to explore and discover.
Absolutely. The beauty of investing is that it's a lifelong learning process. The market is constantly evolving, presenting us with new opportunities to learn and grow.
So let's keep exploring, keep experimenting, and keep striving to become the best investors we can be.
I couldn't agree more. It's been a pleasure joining you on this deep dive.
And thank you for sharing your insights and expertise to our listener out there. Remember, the best investment you can make is in yourself. Until next time, happy investing.